inflationary tendencies might still come through locally. Now, if that's the case, your interest rates haven't really, sort of peaked from a Fed sense as well. So what will India have to do? I think this time around, I think if rates go up globally, we have to follow. Maybe a 25 bips increase or a 50 bips increase over a 12-month view. That's what I have actually held through. But that's like incrementally, not so large a percentage change to honestly change the equations, from a point of view of how economic growth pans out. So I'm not too worried about the rate cycle. That's the way I would characterize it. Yes, there are risks to a large extent that you see in the part one and part two, which is war and what happens to commodities, which we need to acknowledge, but you can't position for it.
Hi, Venu. Good morning. Venu, the Indian markets out here, the domestic flows have been splendid. So pat on our backs as well, because the SIP number is looking very, very good. The problem is the FI number, well, that's dwindling a little bit. And they sold in the past month as well. But there's plenty of money waiting on the sidelines. How are you viewing this, FI flow, the interest in the Indian markets? And also, more importantly, the mid and the small cap party is well and truly on. Are you seeing interest as well from foreign investors towards the broader markets here in India?
Yeah, so very valid questions and pertinent because I had my round of very good meetings globally. So, I mean, just to highlight, yes, the last 1.5, 2 months of small correction in terms of FII outflows that you've seen is more tactical. Honestly, the feedback globally is not about negative India. They're not really worried about India macro story, domestic cycle story, or the next 3 or 10-year story. It's more a period of consolidation, valuations having, sort of hit a sort of a ceiling at this juncture. So there is some episodic correction sort of happening at this juncture from point of view of flows. But $3.5 billion is not like a big deal in terms of, how allocations are shaping up. But the fundamental reality is that I do see a lot of money sitting on the sidelines. Now, this money sitting in the sidelines is not about new money getting created out there or new fundraisings. It is basically about allocations that most of these global/emerging market funds are yet to do into India meaningfully. See, passive weights increase is a different thing, where your China portfolios didn't do well, so you automatically ended up having India having a higher weight. Because of that's a very different thing altogether. I haven't really seen at this juncture very major active shifts in terms of weights. Part of that, as I highlight, is more because of the fact that capability building is required. Quite a few of them, used to look at a few large caps, but they realize that's not the way to manage the market if you're going to be playing only ADRs and buy an Infosys and HDFC, right? That's not like the way to manage your portfolio. You have to basically be a bit more broad-based into India. This is where the conversations were. And I think that's what FII's next stint would be, thinking about how to broaden portfolio into the 150th stock, for example, in terms of market cap. Of course, 250 and beyond is still very tough for them in terms of liquidity. But that's like the next step. And we are actually having a lot of conversations around, on how they should sort of approach that sort of investing in India. Nothing is going to change in 3 to 6 months. These trends in terms of being ready to invest in India, building capabilities, having manpower who understands India is at least a 2-year process. So you're going to see, some money coming in as corrections happen. But then even at the current level, if you have to see a lot of money, you need to see this to happen. And I think this is happening from an Indian construct.
Hire more people to cover those 150 next stocks. Because build capability, right, is what you said. But that's going to be interesting to watch, right, as foreign brokers start to cover, because typically now you got to go to you got to look for coverage, etc., especially if you're on the buy side for smaller companies, which perhaps will change. But will it change because these smaller companies would have already become big, or will they go down when they're still small? I think the latter would be more preferable. Your top ideas, Venu, from here, in terms of incremental upside, absolute incremental upside, if you can share a few names with us.
Okay, so I actually, was trying to resist giving names, but since they're a part of India portfolio, I guess it's okay to mention names rather than digging into details on them. See, the way I look at it is that, look, honestly, as you rightly said, it is also about coverage of stocks. So we don't really have too much mid coverage. It's also, something we would be looking at. But the reality is, I've got a 20% allocation to SMID. I don't really differentiate between SMID and large cap. So there's no argument we're making that, hey, shift from SMID to large cap. I don't think it really matters. These are very difficult to execute trades. We're pretty agnostic to a SMID or large cap. It is just about which business model is correct, where you can generate returns is what our current strategy is. So we have maintained a 20% allocation to SMID. Outside of that, I would probably argue that stocks which we think are alpha generators at this juncture amongst industrials is something like L&T, which I think is a doubler over a couple of years in terms of a cycle view. So the story is not done yet. Outside of that, to play housing and building materials, I'm still pretty positive on building materials as a space. I have Ultratech as a portfolio stock at this juncture. We're neutral on that stock from a house perspective, but it's in the India portfolio, just largely to play the 3-year view, not really the near-term sort of issues around other aspects. Then consumer tech is a pretty heavy overweight for us. So we have stocks like Paytm Delivery, which is Paytm is recently added in the India portfolio, and Zomato. These three are we still willing to hold on for a while, but do acknowledge, I want to highlight that I'm not taking a 5-year view on these stocks. We typically take a year or a quarter's view and then see how things evolve in these business models. So these are 3 stocks that are there in the India portfolio. Financial sector, has been a bit tough for us in terms of how it's shaped up. But laggards like HDFC, we're not willing to let go of that. So it's been in the portfolio for a while. That's something which we still think that would play out well for us over a 3-year view. So that's CFC Bank basically, and then Axis. So there are 2 stocks in the very narrow, smaller portfolio in the financial sector at this juncture that we are holding. So these are a couple of names basically which are top of the mind for us in terms of how we are building the portfolio.
Okay, all right. Thanks a lot, Venu, for stopping by and filling us in with those details and sharing some names as well that are part of your India portfolio. Look forward to having a chat with you rather soon. Well, let's move on then. Cyient, well, that's the next corporate on our radar. For Q2, the company deal wins was solid. Revenue and profit also surged. Although the FY24 company is lowering the guidance to the lower end, which was 15 to around 20%. Mr. Krishna Bodanappu, the Executive Vice Chairman as well as Managing Director of the company, joins us on the show. Hi, Krishna. Morning. Thanks so much for joining in. Well, you've lowered the guidance a little bit to the lower end. Tell us what changed so much in the past quarter. And also earlier, you were saying organically you will grow around 7%, I think so. Now, what are you factoring in organically?
So good morning, and thank you for having me on the call. The reason why we are looking at the lower end of the guidance is, as you may know, the communications sector is a big part of our business. And it roughly constitutes about 22% of our revenue. The communications sector is going through a bit of a challenge with some of the programs being pulled out and delayed and so on and so forth, just because a lot of them are very capital-intensive programs. And with the current interest rates, et cetera, our clients are telling us that they'd like to push out the programs a little bit. So therefore, looking at the softness in the communication sector, if you just peel our numbers, the other 3 sectors, which is aerospace or transportation, sustainability, and the new growth areas, all 3 did very well. In fact, the aerospace sector, which is one of the largest parts of our business and something that we're really known for, grew almost 20+% year on year, and all of it is organic. So we're quite confident about those sectors, but the fact that there is softness in communications, which I think is also evident just in the general technology sector, made us a bit more guarded on the guidance and being at the lower end. In terms of organic growth, we're still budgeting about the same, maybe a tad bit higher, but it'll be in the same range. We don't see any significant change in the organic business.
All right, Mr. Bodanappu, hi, good morning. Just on that aerospace, which you said has grown 20%, has done very well, has kind of offset the weakness in communications. I remember 2 quarters back when we spoke, you said that by the end of the year, you're expecting a cycle to start in that sector, which perhaps should be a bit of a super cycle. Do you see that? Is that developing now? Can you see it? And is that going to be a disproportionate driver for you from here?
So we are seeing some elements of that develop, especially around the defense elements of aerospace. We are seeing many elements of that develop. There are a set of new programs that are being awarded and kicked off and so on and so forth, with the military spend across the world actually increasing, including a number of programs that we've been working on. So we're seeing some elements of the early starts of that. The second thing that's also happening is, as you know, air travel has gone up significantly, which means that the maintenance, repair, overhaul, the sort of the aftermarket piece of aerospace is kicking in very strongly. And that's actually, that's a significant portion. That's almost 60% of our aerospace revenue. and that is picking up very strongly, and that's where we'll see continued growth till the super cycle begins. We're hoping maybe in about another 6-12 months we'll see further meaningful acceleration. But I just want to say the aerospace business by Q4 should be back to its absolute peak, the highest it's ever been. So the recovery has been really good for us.
Okay, that's good to hear that the aerospace business is doing quite well. But you did mention briefly that the communication vertical is going through a big challenge. And, it's a steep slide that we've seen in your telecom business. I mean, it slowed down for the second quarter in a row. And you've also seen almost a 13% year-on-year fall in your, telecom vertical. How long do you think these challenges could continue, and how long before you get back to growth here?
We believe that this quarter is the bottom of that business. Essentially, in a very simplistic manner, the work that we do is really on the CapEx and the build part of a communications network. So as you can imagine, with the current interest rates, etc., much of the build has slowed down. And again, I'll say slowed down because, as you know, again, there is fiber optics, there is 5G. There's just a lot of imperative that has to still happen in terms of what needs to be invested for the comm sector. So therefore, our customers are very confident, and that's what they're telling us, that it's a slowdown till some of their financial elements are sort of start to make sense. But we're quite confident that we've seen the bottom. Now, Q3 might not be a significant growth quarter for comms, but at least it won't slide further. And Q4, definitely, we're confident we're back in a growth trajectory.
All right, give us two more numbers then. Your margins have improved and you have been guiding for that. I think in the quarter basis, it's up by close to 40 basis points. For the second half of the year, what kind of margins are you looking at? Point number one. And point number two, order intake has been fairly impressive, right? At around 180 to 200 million. Expecting that to continue?
Yeah, absolutely. I think on order intake, let me first answer that. I think on order intake, we're focused on a lot of the right areas where there is growth. The growth is not necessarily coming in the same areas that it would have maybe a few years ago. So I think it took us a bit of time to build the capabilities, excuse me, and the credibility in these specific areas. And I'm quite confident that we're built. So a lot of the growth is coming in these new areas, such as the technology areas, in automotive, in some of the digital kind of projects, etc. So we're still quite confident that will continue. On the first question on the second half margins, we said margins will improve 150 to 250 bits for the year, and we'll hold to that. I think there is some opportunities to invest in the certain things that we want to do in the second half. So that's why I'd say second half will not be very different than the first half.
Okay, all right. Second half won't be very different than the first half. Got it. Thanks a lot, Krishna, for joining in. Appreciate your thoughts and have a great second half and a good weekend as well. Let's take a short break. Up next, RG Chandramogan of Hatsun Agro will be joining in to talk about their Q2 performance. We'll also connect with the Mphasis management to talk about their Q2 earnings. Stay tuned. Welcome back to Bazaar Morning Call. We have plenty of corporates lined up, but before anything, let's cut across to Finance Minister Nirmala Sitharaman, who's speaking at the Kautilya Economic Conclave. So some important takeaways from there. Let's listen in.
Outcomes from this kind of 2 or 3 days session, where great minds are putting into the thought process, their own inputs, we need to have some thoughts to be shared globally as well. So I'm setting before you my little expectation from this 3-day session. But I'll also place before you those concerns which are in my mind even as I talk. Globally, we don't need to hesitate any longer to say the multilateral institutions, not just banks, development banks, but even otherwise, whether it's the UN, the Security Council, or any other, WHO, WTO, are less than effective from where they were made into institutions, from at the point when they were brought in. The level of effectiveness by their intervention that they were to bring in the global scenario is today at less than ideal position. Now, because they've become less effective, we've reached a stage where what we took for granted is no longer to be taken for granted. We thought that if there is a disruption somewhere, the WTO would come into play. If there is a huge big pandemic, the WHO would come to play. Similarly, in developmental agenda of different countries at different levels of development, there would be timely and periodic interventions with which you will see some change with the spirit of inclusiveness so that less developed countries will also have some traction towards achieving their aspirations. But we find that less effective in all across the board in all these institutions. So that's one factor that we keep before us. And in that, I'll begin by thanking Larry Summers and N.K. Singh for having come up with some kind of a document which all of us can use, in which I can see Nick Stern and others here, who have all participated to, in a very short period of time, apply their mind and come up with something which the G20 has appreciated, welcomed, and now it has tasked one of its own group to go into how the recommendations can be put to action.
All right, we'll keep cutting back to the finance minister and we'll keep getting you the important sound bites from there. But let's shift focus then to Hatsun Agro product. The company witnessed its margins improve after 8 quarters due to price increases taken in the last 12 to around 18 months. There was a huge jump in other income as well that's aided the company's profitability. Mr. Chandramogan, the chairman at Hatsun Agro, joins us on the show. Hi, sir. Good morning. Thanks so much for joining in. Well, give us a couple of numbers first up. You know, your gross margins have improved, and that's what's helped your margin performance as well. Do you expect margins to head a little bit higher from here on? What kind of a guidance can you give us for the second half of the year?
See, the first half last year we suffered with commodities bound for reconstituting of milk. Now we have enough milk, number one. Number two, our milk arrivals have improved by 20 to 25% in the month of September and October, which gives an indication that the second half cost will be under control. Not only that, we were not into dairy ingredient business. That is one of the reasons for the growth of business being less with a single digit. Hopefully, the second half will have commodities also joining in, and mostly it will join in on the fourth quarter. But in the second half, commodities will also play a role because we have enough milk and we have enough products which we can sell in the market.
Mr. Chandramogan, can you tell us what exactly was the volume growth that you saw in this quarter? And what is the kind of average volume growth that you can do in the second half of the year?
Volume growth has started happening only by September with the procurement. October continues. The volume growth is likely to be somewhere around 20%. Volume growth is expected. And so, this is going to play a...
Sorry to interrupt you. I didn't mean to do that. But 20% volume growth you said would be for the full year, is it? I'm just trying to get the timeline.
No. The first half, we were gradually stepping in, and the second half has got that 20% procurement in hand as of now. So this will reflect in a better sales with the commodities, apart from the branded business, whatever we have. The second half revenue will be better than the first half. Margins will be sustained and maintained, not an issue.
So it's fair to say. So it's fair to say that the volume growth in the second half is expected to be 20%, right? That's what you're saying.
15 to 20%, because probably commodities will not be sold in this quarter. This quarter will not have a better price. So the next quarter only we will be selling the commodities in a big way. And the subsequent quarter we will be holding the stock. So it may be somewhere around 15 to 20%. You can say that.
Sir, good morning. You said you'll hold the margins, but from this 10 to 11% band, could you move to the 11 to 12% band? I mean, is there visibility?
We are already at 12.22 EBITDA. So the EBITDA levels can be sustained without any difficulty with the increased sales in the second half.
Okay. All right. Give us a little details on your balance sheet, sir. I think you were talking about bringing the debt down to around 500 crores in the next 2 years. Currently, you're at around 1,500 crores. You've done a rights issue, I think a QIP as well in the last 12 months or so. Where do you see this debt number end this fiscal? And by the end of FY25, does it come down to that 500 crores?
FY25-26, we are expecting it to happen for two reasons. Actually, we have a heavy depreciation, and also on the interest, there is an Indus which is also about 30 crores. So that is not a cash outflow. The depreciation and cash inflow of Indus itself is more than 400 crores per year. So that will be an inflow apart from the normal profitability what we are looking at. This year, fearing the last year problem, we also kept a heavy stock. So those stocks will get diluted over a period. So both put together, it will reduce the working capital burden and the debt together with a better profitability in the coming second half.
Just to follow up to what Prashant had asked you on margins, you said margins will sustain around these levels. So is it fair to assume that you will, your gross margins in Q2 were around 30%. So that's something that you can hold on to for the rest of the year. Is that correct?
No. I'm only saying EBITDA of 12% plus is possible for the second half. I'm not talking about gross margins and all that. Right.
Okay, so EBITDA of 12% is sustainable for the second half of the year. Got that. And in terms of your debt...
With incremental sales.
With incremental sales, yes.
Debt will start coming down with the dilution of dairy ingredients. By April, May, June, I think the debt will come to less than 1,000 crores in our opinion.
Okay, so less than 1,000 crores of debt by April of 2024. Got that.
No.
So
I'm talking about June 2024. The dairy ingredients dilution may take place and the debt will come to less than 1,000 crores, I'm saying.
Okay. And earlier you had told us that you intend to take the debt below 500 crores over the next 2 years. You hold on to that target, is it?
That's right. I'm talking about only the coming year we will be less than 1,000 by June. And another one more year is there where we can just bring it down to 500.
All right, we'll leave it there, sir. Good luck and appreciate you joining in with all of that perspective. And it's always a pleasure, sir, speaking with you. Let's just take a quick look at what the market is doing. Good time to do that. We're down about, 50 odd points. So it's basically 50 off the lows. 19,571 is where the index is trading at. The low was made early on. It was 19,518. So basically, it's a 50 or exactly 50-point recovery, and we're up 50 as well. Bank Nifty. Take a quick look at what that is doing. I think there is a very good recovery afoot. The low is 43,567, which is pretty similar to yesterday's low. Actually, almost sort of coinciding with the low yesterday, and then the bounce has come through. So let's see where we finally end. Just coming into the green, by the way, the Nifty Bank, as we speak, 43,751. Maybe take a look at some other stocks. Market breadth, which was 2:1 comfortably, that is narrowed now, and the gap is not that much. Just look at these names. IRB is up 4% now. Stocks at about 37. We've got Bombay Burma. That's a big mover. Bombay Burma is up 11.5%. Huge volumes, by the way, on Bombay Burma at this point in time. Bombay Dyeing is up about 5.5% as well. More on this in a bit from now. More stocks, etc., in a bit from now. Mphasis is the next company we are going to be talking about. They've reported a good set of numbers for the quarter gone by. Actually, we'll just come to the Mphasis numbers. Okay, I think we have the Mphasis numbers, the management with us. So new deal wins came through with the companies, and the company's maintained its FY24 margin guidance as well. Nitin Rakesh is Managing Director and CEO at Mphasis. He's joining us right now to take some questions. Nitin, good to have you with us here. Thank you very much. Nitin, in the quarter, so as to speak, the revenues have been flat. Constant currency revenues are flat, whereas the direct business revenue is up about 0.3% again Q-on-Q. In the previous quarter, you had indicated that sequential growth in Q2 over Q1 will accelerate, which hasn't really played out. Could you tell us what happened and what is the outlook from here on?
Sure. I think basically what we said was we see the growth to be back-ended towards the second half of the year, and we definitely saw signs of stabilization in two of our segments that were definitely headwinded prior to Q2. So while TCV conversion to revenue has picked up, it is still lagging where we think it should be, even though pipeline to TCV conversion picked up last quarter, and for the first half we have almost a 60% jump in our order bookings. So from that perspective, I think the uncertainty around conversion continues. There is higher scrutiny on discretionary spends that definitely played into some of this leakage in growth. However, we are pleased with the fact that because of the order book and the strength of our deal wins, we managed to stabilize the overall headline number, despite the fact that in this quarter again mortgage declined, even though not as much as it has in the past, and our visibility to that decline is behind us today. So in terms of where we think we are, definitely made a lot of progress through the quarter in stabilizing revenue. Very pleased with the fact that we expanded margins, albeit with a small extent, but stability in margins has definitely been a key outcome of our efforts over the last few quarters as well.
Okay, that's good to hear. Nitin, hi, this is Sonia here. So you're saying that there is uncertainty around conversion, and some of your peers have mentioned that as well, higher scrutiny, with regards to discretionary spends. So in terms of decision-making from clients, has it improved compared to when we spoke last? And if yes, what is the visibility looking like in the second half of the year with respect to deal wins?
Hi, Sonia. I think issue is uncertainty creates inaction, and the macro environment obviously has remained fairly volatile. It's one step forward, one step backward kind of environment. And with the continued spike in 10-year yields, it's very, very hard to call what will be the next action on the macro front, whether recession is going to be induced, how deep it will be. So it's very hard to take a business call based on a very uncertain environment. And I think what our clients have managed to do or continue to do is what we call relentless prioritization. There is a certain degree of digital duality under play as well, because on one hand, they're tightening discretionary spends, their scrutiny is high. Even though deals that are signed, are taking longer to ramp up, in some cases getting extended out from a duration standpoint. More importantly, I think there is also a very strong appetite from many customers on figuring out how they can benefit from implementation of some of these AI solutions. So I think it's an interesting environment. The outlook from our perspective is much more at this point in time micro-driven. Order book, account, vertical, geography. What can we convert? How quickly can we convert it? How many deals can we bring in? The pickup in decision making from the conversion standpoint is pretty okay in terms of pipeline to TCV. TCV to revenue, I think, is still not where it needs to be. It hasn't reverted back to where it was, I would say, a few quarters ago.
All right. Hi, Nitin and Manish. The last few quarters when you have joined us, I've been asking you all, what are you going to do with the cash? Now, we've seen some movement. You've spent around $130 million on that Sonic Partners acquisition. They did revenues of around $75 million. They've got it at around 1.7 times. Give us a couple of details. How much will it contribute in FY24? What about FY25? How do you see the revenues ramp up? And also, what is the margin difference of this acquired entity with Mphasis' margins?
So I can maybe give you a very quick thesis for the acquisition. I think, as you rightly said, Nigel, we've spent some of that cash in a strategic acquisition, which is capability accretive. Definitely brings us a competency from the Salesforce ecosystem. Fairly, well established that in the customer experience transformation landscape, combined with Einstein's AI offering, the Salesforce ecosystem has certainly become fairly attractive as we think about extending our experience design as well as contact center transformation archetypes. Secondly, it's also leadership accretive. We expect it to be growth accretive because there is a synergy revenue opportunity with our existing clients, not to mention that we've also acquired a pretty good set of marquee logos in financial services, healthcare, as well as media. I think the 75 million number is kind of the quarterly annualized number. I think the impact of that in current year will probably be less than half of that. And Manish can give us a little bit more breakdown on what we expect and when we expect the synergy to play out and what the margin profile is.
Nitin, on the mortgage side in the US, sorry, I think Manish wanted to comment. Manish, you wanted to sort of pitch in? Sorry,
I just wanted to add to what Nitin said that the Sonic Partners, which the name of the company is Silverline, we will look at them at driving the whole Salesforce business for us, and on the combined basis, we expect that business to generate somewhere in the range of $38 to $40 million in the current year, and this will get consolidated effective 1st of October.
And for the next year, how does it ramp up then?
It's a growth accretive business, and we haven't disclosed the numbers in terms of what the growth expectation is, but it will certainly be higher than the company expected growth rates.
All right, Nitin, I wanted to ask you. So far, you mentioned the rates in the US, etc. But the mortgage market, which was the last trouble spot in 2006-07, it was a different issue, different era, I guess. But that's the market which is resilient still, with home loan rates in the US being 7, 8, 9%. What are you seeing there? Is it going to remain steady, or when things start to slow, that will be hit big time?
I think it's actually already taken a pretty big impact in terms of origination volume. So if you look at first mortgage, which is when you buy a home, you take out a mortgage for the first time, that volume is down fairly significantly in the last 12 months, up to as much as 60%, because 7.5%, 8% 30-year mortgage rate is more than 2x of what it was just about 6 quarters ago. I think where we've seen resilience is in the home equity line of credit, where you have equity in the house, you go and you take a loan against that. And the reason for that is that the housing prices have actually been fairly stable. So on one hand, volume loss on the origination, refinance market's obviously fairly dead, given that it's very hard to refinance at a higher rate. Home equity line really stood up, and of course, diligence services has stood up as well. I think at this point in time, what we've seen in the last 3 to 4 months play out is as this downturn has extended on the mortgage origination side, many large mortgage providers, banks especially, have now realized that this is a good time for them to transform the way they run these operations. And we are a best-in-breed provider in that segment. So we've actually seen wallet share gains. We've seen bank captives turning over business to us and saying, you probably can run it more efficiently for us, and we can variabilize our cost versus having to run a fixed cost with headcount and infrastructure. So a large part of our optimism, at least on that line, even though it'll take a while for it to get back to the peak of what it was for us a year ago, I think the large part of the optimism comes from the fact that we've managed to actually win new orders in that segment, given just our focus and our specialization in that space. And some of that will play out in Q3 and in Q4 in terms of sequential revenue growth.
Okay, Nitin, one final question, and if we can make it quick because we're running out of time, but I do want to get your view on board because, the BFS segment is almost 50% of your overall revenues, right? Are you seeing any signs of an incremental slowdown over there? And what is the prognosis for the BFS segment in the second half?
Yeah, I think, Sonia, the regional banking crisis overhang continue to persist at least in Q2. We are seeing some signs of stability. It's hard to call what happens in a seasonally weak quarter, given that most banks are fairly used to a furlough construct. As we get into next year and budget, we start doing budgeting, reviews with customers. I think, given the resilient segments of consumer banking, asset and wealth management, I think there'll be more nuanced play on where stability arrives first and where we may see some sluggishness, especially in capital markets that are very much linked to deal activity. So a little bit more nuanced story on the BFS side. Hard to call a bottom on the macro, so we're not taking a macro view on that segment either. We're going account by account and making sure that we're able to win wallet share and market share.
All right, we'll leave it at that. Thank you so much, Nitin, Manish, for joining in, and all the best for the quarters to come and for the second half of the year. Well, let's get back to the markets now. The market is actually pulled back from the lows. Mitesh is with us. Mitesh, how are you feeling about the market? It's buying the dips, but I mean, actually it's all over the place, to be honest. But what do you see as a trajectory for the second half?
See, but the good thing is that the bank Nifty is stronger than the Nifty today, and that is kind of giving support. I think we are closer to support areas, but the structure is weak. So I would, change the strategy to buy from buy on dips to about selling rallies, and closer to about 43,800, 850 is my selling zone on the bank Nifty. We already have some put options positions, but that is the area which I would want to short around and keep a stop above 44,100. Once we break 43,200, I think that will be the time when you might want to go aggressive on the futures side, and that breakdown below that 200 average could see a trigger or a stronger supply pressure on the indices. So wait for that. Till then, maintain a negative bias. On the stock side, I have a sell on Apollo Hospitals. Keep a stop above 49.80. Look for a target of roughly about 48.75 on the downside. While I would want to venture into a long position on Cipla closer to about 1200 with a stop below 1185 for a target of 1235.
Okay, all right. Got that. Mitesh, we'll take a quick commercial break here and we'll keep coming back to you for more, but we'll come back and put the focus on commodities. Manisha is going to be here with that in just a bit.
All right, let's focus on the commodity markets now. Manisha Gupta joins in. Manisha, what's the one commodity that you're tracking this morning?
Well, Sonia, I'm looking at the overall sector because it's been a week now when the conflict between Israel and Gaza began, and we have seen many of these commodities actually react on the higher side in sense of a safe haven. So most of the commodities are trading in the positive. The US dollar index also has come off its highs, and that seems to be supporting. And the street is now concerned that the conflict that is between Israel and Gaza, I beg your pardon, could actually spread to the nearby areas, and that has added premium to the prices. Apart from that, the street is also reacting to the Powell speech yesterday, where he did talk about inflation concerns and labor markets, but also did not signal another rate hike in the month of November, and that's what the street is reacting to. While, of course, the markets are prepared for higher rate interest for a longer period of time. The US yields also rising to 5%, near 5%, which is the 2007 highs, is something that seems to be pinning down many of those commodities there. Well, the street also is looking at the Chinese data that has come in on the positive side. The infrastructure investment, the fixed income investments have been on the higher side. The 1-year and 5-year lending rates have been kept steady from China, which is near record lows, which was on expected lines in any case. And the strong third quarter GDP numbers, which came in on a higher side on a quarter-on-quarter basis as well, have been supportive for many of the industrial non-agriculture commodities there. So take a look at the crude oil prices, and we have seen the Brent gain up by 2.5% in this week, and this is on top of 7.5% of gains that we saw in the previous week as well. Ditto goes for the safe haven buying that we have seen in case of gold. That one is trading at a 3-month highs right now. We are inches away from $2,000 per ounce, and gold is up 2% in this week after gaining 5.5% in the previous week. In case of metals, the best of the gains have come in for the ferrous space, where you have seen steel and iron ore gain anywhere between 1 to 2.5%. Copper prices have been surging as well, 1% on the higher side for that. And aluminum prices also have managed to be in the positive right now. That is because we have seen inventories decline, and the spot markets are looking at the lowest discount in last 3 years. So just about $9 to $10 a ton. So there is buying coming in on the ground, and there is safe haven buying as well, and that has been supportive for most of these.
All right, thanks a lot, Manisha, for that. Well, let's slip into a quick break. On the other side of the break, our special segment, It's the Economy. Lata will get chatting with Indraneel Pan of Yes Bank and Sakshi Gupta of HDFC Bank to get a sense of India's macro environment as Q2 earnings season unfolds. Stay tuned.
From earnings seasons to it's the economy. Some trends from the first set of second quarter results show some disturbing takeaways for India's macros. For instance, the top 4 IT companies, Mphasis, TCS, HCL Tech and Wipro, tell us that together they have reduced their headcount by 22,000 people in Q2. TCS 6,333, Infy 7,250, HCL Tech over about 2,250 and Wipro over 5,000. Now, separately, FMCG company results that came yesterday, HUL and Nestle have reported very low volume growth, 2% and 4%. Also, as we now know, the global cost of capital has shot up with the US yields rising, and this has forced, for instance, Indonesia, the first Asian emerging market to raise rates. India has effectively raised rates by tightening liquidity. As you can see, the interbank repo rate, the interbank call rate is at 6.75. It ought to be at 6.5, the repo rate. So, are the clouds gathering for a likely lower than expected GDP growth in the second half? All these are anecdotal evidence, but I'm asking this question to 2 macroeconomists, Sakshi Gupta, the Deputy Vice President and Senior Economist at HDFC Bank, and Indranil Pal, the Chief Economist at Yes Bank. Indranil, Sakshi, thank you very much for joining us. First question that, Indranil, you saw the kind of headcount fall that IT companies reported, and all of them said they have not issued letters to the freshers. They will not, some of them have said they won't go to the campuses in the coming hiring season. Is this giving you a sense that we are in for a difficult next few quarters of growth?
Obviously, this will have an implication in terms of the way we were expecting consumption demand to move. Now, obviously, again, we are sort of in a phase where global slowdown is likely to hit. And even though some of these IT companies have reported a good deal pipeline going forward, I think the overall atmosphere that is building up is that companies or the deals relatively are at a value size which is relatively lower than expected levels. So these are some of the factors that will definitely affect consumption behavior going forward. And I think out of COVID, the expectation that we had that we'll have a more balanced growth, that probably is still not happening, which is clearly evident by the fact that the FMCGs have been reporting relatively lower volumes. The upper end of the income pyramid continues to spend quite significantly, and that's holding up the consumption demand to an extent. The lower end is surely suffering, and rural economy is possibly one of the worst hit, in my opinion. So these are some of the factors that could actually lead to lower GDP growth. However, there's a lot of uncertainty in the data that flows. For instance, the IMF has actually now moved GDP numbers higher by 40 basis points. The RBI holds it at 6.5%. On the other hand, we will look at GDP being at a 6.1 to a 6.2%, with likely to be a second half, which is relatively much softer than what we saw in the first half.
Okay. So I'm just asking you one word. Is there a downward bias to your own forecast? What's your forecast? Is there a downward bias?
To a certain extent, we have taken most of these into consideration as we did our numbers before. And as the RBI clearly says that the pass-through is still not fully done. And
yeah. So what's your number?
It is more likely to be 6.1 to 6.2% is what we are looking at.
Okay. Okay. Sakshi, I'm presenting the same data to you. Headcount numbers lower, is it likely to hit consumption further? And if you can also analyze the consumption trends already available to us, which somehow seem a little under the weather going by the recent numbers. What's your take on second half growth?
Right. So I kind of agree that yes, given the tightening financial conditions globally as well as in India and the trends that we are seeing on the formal labor sector side, and also, mind you, not forget the risk of higher commodity prices, especially oil, with the geopolitical tensions that are going on, does present a downside bias to how growth is going to perform over the coming quarters. That being said, I think we also need to recognize and understand that there are a lot of divergences and nuances to the data that we are looking at. And I agree with Indranil that it is not uniform. There is a lot of of differences. So, for instance, when we are looking at formal sector employment, in the recent data also shows that while urban unemployment rates are going up, on the rural side, we've actually seen a slight moderation in the unemployment rate. Similarly, I mean, we are seeing hiring intentions go down in, software and the IT sector, but at the same time, you have sectors like construction, oil and gas that continue to see very strong YOY growth in their hiring. So it's very mixed at this stage. On balance, I would, still hold on to my 6.3% growth number for the whole year. I think that the second half of the year usually tends to be, stronger in terms of the sequential momentum because there are, seasonal effects. But compared to last year, perhaps this time the sequential momentum is going to be lower.
Okay. What about the next set of factors that are upon us? US cost of capital at 5%. Very clearly, Indian authorities, all Asian economies will have to react. Indonesia has reacted outright with a rate hike. India is not announcing a rate hike, but effectively, there is a 25 basis rate hike for the past quarter. Repo rate has been at 6.75. Do you see, Sakshi, first to you, this having an impact on consumption in the days to come as credit card cost, loan cost goes up, home loan costs go up? Are you seeing an impact?
Right. So, as I said, yes, we are looking at tighter financial conditions going forward because, the RBI has also gone ahead and said that the impact of the past rate hikes hasn't really filtered through. And clearly, there is this intention to tighten liquidity further and raise effective interest rates in the economy. So I think in certain segments, you are going to see, an impact on consumption. While I think taking the example of, let's say, the housing sector, there are segments where consumers don't tend to be so sensitive to interest rates. Again, at the broader economy level, yes, tighter financial conditions do mean that there will be, a consumption slowdown. I think credit growth still continues to remain very high. And I think we will start seeing some moderation as we move into the coming quarters. But then again, you're going to see, some segments of the, credit portfolio that remain resilient despite, the interest rate increases because they are less sensitive, to the interest rate.
Yes. Yes, of course, consumer discretionaries will do well. But I can point out to a couple of discretionaries that have not done well. We got the travel numbers, didn't we? And there is a Citi report that has hit us just this morning, which is pointing out two areas of urban consumption getting hit. One is services exports are not growing anymore. The last services exports number we got is barely 1% higher than year-ago levels. And the second one is travel numbers are also moderating for September compared to August. So, Indranil, until now, the worry was rural consumption has not picked up, and Hindustan Unilever seemed to say the same thing in their earnings call yesterday. But are you getting doubts over urban consumption also?
No, rather than sort of segmenting it through the urban versus the rural, I think the essential point here is that because of the higher inflation and because of the higher cost of capital, the point is that the essentials are probably getting hit to a large extent. But as Sakshi also mentioned, that there are pockets definitely where the demand for the housing remains strong. And more in terms of the affordable housing, I think the government is trying to soften the blow by the interest subventions that subventions that they have started to do in terms of the housing sector. So yes, again, Sakshi, I think is a point taken forward. The urban consumption demand in terms of the asset building will continue. So the critical factor to look at is more in terms of how much the essentials are basically hit, and that I think is remaining crucial in my opinion.
Is that a big factor then? Already our government has announced the numbers we got, and these are still source based. But Minister Hardeep Puri confirmed that the plan is there. 60,000 crores interest subvention over 5 years. The actual amount that will come this year itself is going to be very less. because the plan has to be announced and then banks have to be approached for low-income housing and then they will give a loan subvention. It doesn't seem to be happening this year. So do you think this year's growth is kind of a prisoner to the government announcing some pre-election SOPs, Indranil?
I wouldn't call it as a pre-election SOP. I think it is more like the managing of the economy so that along with the global atmosphere that is building up in terms of the uncertainties and the crude also moving to a $93 a barrel, I'm talking about the Brent, it is how you use the fiscal policy to soften the blow on the economy, and rather than a sizable downside, you actually manage the downsizing of the economy to that extent. So I would hesitate to call it clearly as an election SOP, because this will have a relatively longer term implication in terms of the benefits.
Yeah. No, I agree with you. If it's only a question of reducing the excise duty by 1 rupee or 2 rupees, like they did in the previous instance, it would be softening the blow. But who is to say that they are going to stop with only a fuel subvention or a subsidy? Last time we had the PMGKY, which was 2,000 rupees given to every family before the vote on account started. So some such a scheme is widely expected. But very quickly, Sakshi and Indranil, I want your next year numbers from you. You're standing at 6.1 and 6.3 for the current year. Sakshi, next year's numbers?
So for next year, we are looking at 6.4% as of now.
Okay.
There are, of course, base effects. Yeah, there are, of course, base effects that would still be at play. So, it gets reflected in the overall growth number. Yeah,
and we don't know how global growth, what shape it will take. Indranil, your FY25?
My fear is that I would be looking at a 6%, because I think it was at an extent post-COVID, there is a deadweight loss that we are carrying. And we are expecting the global growth to be relatively more slower in the next calendar year compared to the current calendar year. And with the higher for longer sort of message playing out for a relatively larger period of time. So I would be looking at a 6% rather than looking at growth being higher compared to this year.
Okay. Thank you very much, Indranil and Sakshi, for going through the early trends that we are getting from the Q2 numbers. The verdict from the economists is that at the moment they are not changing their GDP forecast, though there are fears, some red flags over the second half pace of GDP growth. 6.1 for Yes Bank and 6.3 from HDFC Bank. Remember, the RBI stands at 6.5, so does the Government of India. But the street is not convinced. If anything, there is a downside bias to expectations. Wrap up on Bazaar on that note. Chartbusters up next.